Have you ever wondered how investors make money from a stock market crash, or they profit from betting against certain stocks, hoping those stocks will fall? There are three ways that investors can do that. They can do it with inverse ETFs, or short selling, or using put options. We'll talk about all three in this video. Hey, welcome to Stock Sessions. My name is Jeffrey Lin. So as always, just a disclaimer, these videos are only for educational purposes and these aren't recommendations or investment advice. So during this 2020 stock market crash that we just experienced in March, everything fell, everything lost value. There was no safe investments. There were no safe stocks, stocks that people usually refer to as defensive stocks like utilities fell along with the rest of the market because investors have to sell whatever they can to raise cash, whether if they need it to support their businesses or they're just scared and they need money to pay for their mortgages or something else. Everything got sold. If you look at these charts right here, the S&P started selling off earlier in February, but starting here in March, the S&P fell, taking another leg down. And looking at gold, also here in March, it also fell at the same time. If you see this decline right here in the S&P 500 matches the time when gold also fell by a huge amount. And people usually try to diversify to having bonds in their portfolio, thinking bonds would also be safer. But again, in this couple days in March, bonds also fell. So all asset classes fell during this time. There was no safe stocks or assets to hide in. So what do you do when everything's going down? Well, the safest thing for most investors to do is you should take profits and you should go to cash either at the top of a bull market cycle or as soon as there seems to be the start of a recession, you should sell and go to cash. But if you're more aggressive and you want to profit from a stock market crash or a stock market decline, then there are three ways that we're going to talk about of how to do that. First of all is the inverse ETF. Second of all is using short selling. And third is put options. Now, these strategies are more advanced and more dangerous. If you can't do these or you don't feel comfortable doing that's just fine. This is more for your information about how it's possible and maybe something you will look into to either protect part of your portfolio or if you're more aggressive, you can slowly learn how to do these techniques and benefit from certain stocks falling or from the next recession or stock market crash. The first and easiest way to benefit from a stock market decline would be using inverse ETFs. ETFs are sort of like mutual funds, except they have less restrictions, less fees, and you can buy and sell it on your broker several times a day. You can trade it like a stock. An inverse ETF just moves opposite of the direction that the stock index will move. So let's say the S&P 500 index goes up by 1%, then the inverse ETF will go down by 1%. If the S&P 500 goes down by 1%, then the inverse ETF will go up by 1%. Here on the top, I have a chart of the S&P 500 ETF. The symbol is SPY. On the bottom, I have the inverse ETF. The ticker symbol is SH. These are almost mirror images of each other. You'll see all this time when the stock market was going up. See all this time when the S&P 500 was going up, the inverse ETF was going down. As soon as the stock market started to crash, the inverse ETF started to rise. And recently we had a stock market bounce right here. And you see the inverse ETF moving in the opposite direction by going down. So this is a very simple and straightforward way to bet against the market if, for example, you feel like up here, if you felt like the stock market was too high and was ready to drop, instead of just cashing out and selling everything, you can also take that money and buy the inverse ETF down here and make money, profit, during this time when the stock market was dropping. Let's look at another example using the Nasdaq 100 index as an example. You'll see that, again, these two look like mirror images of each other. The top one is the Nasdaq 100 index. The symbol is QQQ. And the inverse Nasdaq 100 index, the symbol that you can buy with is PIQ. So again, you'll see most of last year, these technology stocks were going up. So the Nasdaq 100 index ETF went up. At the same time, the inverse ETF, you would expect it to do the opposite, which meant it went down. When we hit the stock market crash earlier this year, right here, you'll see at the same time, the inverse ETF made money. Now I have to give you a couple warnings about inverse ETFs. Inverse ETFs can be dangerous because over time the stock market usually does go up, especially in the US. So these times when the stock market will fall, which means the index ETFs will profit and go up, these times don't last very long. So these are more short and intermediate term trades or investments. Some people only hold it for a day or a couple days, maybe up to a couple weeks, but these aren't long-term investments. These are either temporary trades or it's temporary that you can buy some of this to protect your portfolio. Because let's say if you're holding a bunch of other stocks, like let's say you have Apple, Amazon, and you didn't want to sell those, but you felt like a stock market drop was coming, you could also buy the inverse ETF. So let's say your Apple and Amazon stock will fall while the inverse ETFs goes up, and then the profit from one will kind of offset the loss from the others. The other problem with inverse ETFs is the compounding issue. What do I mean by that? When you compound profits and losses over time, they start to differ by a lot. So we can use this example to show this would be the inverse, and this would be the regular index. As I mentioned, the inverse just moves in direct opposite direction as the index. So if the index goes up 1% a day, the inverse goes down by 1% a day. But if you compound that by 10 days, let's say if the index goes up by 1% per day for 10 days, the index would have gone up not only by 10%, but it would have gone up by 10.5%. Meanwhile, the inverse would have only gone down by 9.5%. That's just how compounding works. And these differences magnify over time. So if you have the index going up by 1% per day for 100 days, your profit would be 270%. What would happen to the inverse is it would drop by about 63%. So over time, these compounding issues make it so that it's not going to track the direct opposite of what the index will do. This will only track it pretty well over a couple days, or maybe a couple weeks. And the last restriction about inverse ETFs is that there are only inverse ETFs for these indexes like the S&P 500 or the Nasdaq. There aren't any inverse ETFs for stocks, so you can't use these to bet against individual stocks. So let's say you felt like Macy's, the department store, was going to fall. You can't use an inverse ETF of Macy's to bet that Macy's was going to drop. To bet against individual stocks and profit from when those stocks go down, you have to use more advanced strategies such as short selling or using put options. So you probably heard about short selling in the financial news and how certain professional investors use short selling to profit from a stock falling. But most people don't really know how short selling actually works or how to do it themselves. So a very simple example is, let's say you have this iPhone 10 and it's brand new and it's just sitting in your closet somewhere collecting dust. And I come over and say, hey, can I borrow this iPhone for a couple days and I'll give you one back? And you say, sure. So I go and find somebody to sell this iPhone to for $1,000. So now I have $1,000, but I owe you an iPhone. So I go and find the exact same iPhone on sale and I buy it back for $800. So I give you back your iPhone, and in the process, I made $200 because remember, originally I sold your iPhone for $1,000 and then I went and bought it on sale for $800. So the difference right there is $200, which is the profit that I make. So how would this work with the stock? Well, let's look at this chart with Tesla and see how we can short Tesla stock. Let's say you want to short Tesla up here. So you want to short it up here at $900. What that means is you would go to the broker. Automatically, this all happens behind the scenes, and you would borrow a share of Tesla and you would sell it. So you would immediately collect $900 when you shorted the stock right here, and eventually when you bought it back, maybe somewhere down here at around 400, your profit would be $500. And you have to buy back the share of Tesla because remember, you still owe your broker the share of Tesla that you originally borrowed from them to sell at $900. So after you buy it back, you give that share back to your broker, and the broker has their Tesla share, and you made $500 from this short sale trade. It's exactly for this reason that you have to borrow shares from your broker to do any short selling, that there are more advanced requirements on accounts that can do short selling. So most accounts can't do that. You can apply for it if you have certain trading experience and if your investment portfolio value is above a certain size, then your broker would approve you to have a margin trading, which is just a fancy way of saying that you would be able to borrow either money or stock from your broker. Now, short selling is very dangerous in an advanced strategy because you can lose a lot more money than what you initially put in. For most investors, the worst it can get is that your account can go to zero and you can lose all your money. But with short selling, you can actually lose more than that. So let's look at an example again using this Tesla chart. So let's say you got the direction wrong. You were trying to short Tesla, but instead of it falling, the price went up and you had to buy the share back at a higher price. So let's say you shorted Tesla here at around $300 and you collected $300. right? Now, instead of Tesla falling like you were hoping it to do, Tesla went on a huge bull market run and it went all the way up here to about $900. So if you ended up having to buy it back at $900 up here, you would end up losing $600. And if Tesla had gone up even more, you would lose even more than that, several times more than the initial amount of $300 that you got from selling that stock. And again, I can't emphasize this enough. Short selling can be very dangerous because you can lose an infinite amount of money essentially if the stock you're trying to short kept on going up and up and up. So just remember, always use your risk control, risk management, and always use your stop. So after a certain point, if you lost too much money, you have to get out. So the last strategy for profiting from stocks declining is the put option. And options also require a margin account, so it's also a more advanced strategy. But at least with put options, your losses will be limited to how much you pay for the option. Sort of like when you buy a stock, if you buy a stock for $100, the most you can lose is $100. Same thing with options. If you pay $100 for an option, the most you can lose is $100. I'm just going to explain conceptually what put options are and kind of how they work. Actually teaching you about options is kind of beyond the scope of this video, so we'll have other videos on the Stock Sessions channel to do that. So put options basically go up in price when your stock falls below a certain price. It's called the strike price. In a way, it kind of acts like an insurance, so you can protect your stock below that strike price. Explained in a different way. So if your stock fell below, let's say $100, and you bought a put option for the $100 strike, that would mean that once the stock falls below $100, your put option will start going up in value. So you'll kind of offset your losses from the stock with the profits from the option. So again, if your stock falls, your option price will rise, and it kind of offsets each other. So put options are often used sort of like insurance. You can also just buy a put option without already having the stock. So if the stock falls below $100 and you bought the $100 strike put option, that means the put option will increase in price the further the stock falls below $100. But there are other characteristics of options that make them harder to deal with that are different than stocks. So basically, options have an expiration date. So when you hit that expiration date, that option becomes worthless. So when you buy an option, you always want to sell it before you hit that expiration date. Again, let's look at Tesla, but this time let's look at the put options. We'll just go through this options table and kind of point out a couple things. So right here in the center, you'll see that what I was talking about with the strike price. So these in here, these are all the strike prices. So for example, this $490 strike price, if you bought this option, it would go up in value if Tesla falls below $490. Now looking over here, you'll see the date. This is the expiration date. This options contract will only last until May 15. So when it hits May 15, this option contract will be worthless. So if you have any profits before then, you're going to have to sell it. And finally, each option contract represents 100 shares. So when you look at option prices, you have to multiply by 100 to get the actual price that you would pay for that option. And again, just to emphasize, the danger with options is they can become worthless. they'll go to zero. There is an expiration date. So if you're not comfortable using options, you shouldn't use this strategy. This is just something good to know and maybe something to look into. Just like with short selling, this is something eventually you can use to have more tools in your toolbox for your investment portfolio, but this is definitely not something for beginners. All right, guys, thanks for watching. Again, my name is Jeffrey Lin for Stock Sessions, and I hope you found this video was helpful in helping you understand the various strategies that investors can profit from a falling market or a falling stock. All right, thanks. Remember, hit the subscribe button, and we'll see you in the next video.